Hello everyone, good morning. My name is Adam Livingston. Some of you may know me as the Bitcoin Wizard. Every single week, I get asked the same question in my DMs. Dude, why are you so obsessed with Bitcoin? They assume it's the price action, the clout, the memes, but it isn't. I care because I'm watching the livelihood of my countrymen leak away like sand through an hourglass that someone drilled a hole in back in 1971. So today, I'm going to be running a forensic, economic, and cultural autopsy on that single policy decision, the moment that President Nixon severed the dollar from gold. The radiation from this decision has been drifting through wages, prices, politics, and our culture ever since, and I believe that this was the year that our country was ruined. So the plan is pretty simple. We're going to rewind back to the Bretton Woods era where money still had a skeleton, then we're going to watch Nixon swing the axe on August 15th, 1971, and then we're going to follow the shockwaves through wages, inequality, debt, geopolitics, and even cultural attitudes toward work, family, and risk. All of this affects us way more than people realize, so I want to show why Bitcoin is the first credible exit ramp in half a century, a monetary system that cannot be printed, lobbied, or bailed out. I'm not here to dunk on the dollar for sport. My grandparents bought a home on a single income and raised 4 kids. My generation budgets for rent and existential dread. And you know what? I just refuse to accept that as normal. By the end of this presentation, you'll see the straight line connection between 1971 and the problems that you feel in your wallet today, your workplace, and your politics. All right, time travel goggles on, everyone. We are landing in 1944, Bretton Woods, New Hampshire. Picture the post-war world itching to rebuild. So the deal that they struck was pretty simple. Every major currency in the world would measure itself against the US dollar, and the dollar would measure itself against gold. $40 an ounce, give or take a handshake. So that golden leash kept credit creation on a very tight diet. Bankers hated it, but global trade loved it because everyone knew that the yardstick was honest. And then you fast forward to August 15, 1971, President Nixon steps on national TV and pulls the pin. No more gold convertibility, plus a temporary import surcharge that never really went away. You used to be able to walk into a bank and exchange your dollars for gold, and Nixon said no more. So overnight, the dollar started free-floating like a balloon that slipped out of a child's hand. The price discovery doesn't happen in vaults any longer. It happens on Forex terminals in Manhattan and London. And this is why this was such a nuclear event, folks, because once dollars no longer linked to a scarce reserve, governments unlocked something called unlimited credit expansion, which is a phrase that polite economists translate as print now and pay later. And that move rewired global incentives across the entire economy. So then saving became a sucker's game and leveraging became a career path. And if you look at this quote by Nixon right here, he tried to sell it with this feel-good patriotism. The strength of a nation's currency is based on the strength of that nation's economy, which really means trust us, we got this. Spoiler alert, they did not. In 1971 was the monetary Rubicon, and we crossed it. Money stopped being money and it turned into policy. So once we crossed that river, there was no marching back to Rome, kids. So we're gonna get to some graphs in a second, but picture one in your head right now. Picture 2 lines, one is orange, one is blue. From 1948 to 1970, they dance in a perfect lockstep. Workers produce more, therefore the workers earn more. Some people might call that a socialist paradise, but that is hardly the truth. It is just a fair split. And then boom, in post-1971 America, the orange productivity line rocketed north, while the blue line that represented wages just turned into a pancake. According to the Economic Policy Institute, output per hour is almost up 2.5-fold, but take-home pay looks like it's stuck in traffic on the I-95, and that, my friends, is the great divergence. And then economists just throw up these 3 usual suspects under the bus. Globalization and offshoring, which means your job didn't vanish, it just got a passport. Automation and IT diffusion, because robots don't sleep or go on strike or ask for dental insurance. And then there's declining unions and policy changes. Collective bargaining swapped for collect your badge and hustle. It was a cultural change. Now, all 3 of these somewhat valid points, but they skate over the ice without asking why it was cracked. So then if you peel back the monetary wallpaper paper, it's very obvious. Once credit became limitless, asset prices, so think stocks, real estate, everything that's denominated in US dollars went on an IV drip of cheap money. So that means the rich, the capital owners, they surfed the asset wave while labor's bargaining chip, scarce time, keeps losing purchasing power. So that means the deck got reshuffled so the house always wins, and guess what? The regular wage earners aren't the house. And the sad truth is that you cannot fix this with another job training seminar or a tariff tweak. The asymmetry is baked into a fiat system that rewards leverage and not sweat. And that, ladies and gentlemen, is why the real GDP line, the gross domestic product, looks like a Bitcoin price chart. Meanwhile, the median male income flatlines and turned into a pancake. And I included this graph on median female income. As you can see, since 1970 on, we have still seen somewhat steady growth with female wage earners. I would assume that's going up because they need to make more money because their husbands aren't. Actually, I'm not assuming. That's exactly why. You can look up the rate of how much more women had to enter the workforce just to keep things afloat. This is mathematical reality. It's not an opinion. So when we talk about GDP growth versus the real wages, we've seen a whole lot of paper gains and a whole lot of real pain. The reality check is that the median real wages have moved 0% on a good day and maybe a rounding error above 1970 levels when you use CPI, which is the Consumer Price Index. So now that is over half of a century. I'm counting 54 years and 1 month of congratulations, here's your cost of living adjustment coupon. Hope you like ramen. Despite our gross domestic product per capita rising 4x from 1947 to 2024. And that's coming straight from Federal Reserve data. So how do you square a roaring paper economy with a flat household paycheck? Enter the Cantillon effect, which means the first receivers of new money, so think banks, hedge funds, large corporations, they get cash at yesterday's prices. Then they buy assets, they buy lands, they buy equities, and by the time that money filters down to wage earners, the price tags have already gone vertical on their assets, which means the purchasing power got siphoned. Game over. So when you see politicians waving a GDP chart and saying, look, prosperity, ask them, whose prosperity? A 4-lane highway of freshly printed dollars runs straight into asset markets, while Main Street just gets the fumes. And I think we're all feeling that today just a little bit, folks. And remember, the GDP is measured in dollars, so if you inflate the denominator, what it's denominated in, the number looks heroic, even if the lived experience feels like a treadmill that we're on, set to a max incline. So I want you guys to picture America in the late 60s, you know, the golden years, a blue-collar family, one paycheck, one car, and maybe a black and white Zenith TV in the living room. The Beatles were still together, life was good. Then the income ladder looked very climbable because every rung of the ladder moved together. The Gini ratio, which is a measurement of income inequality, was around a 0.35, which means the real family income in the 20th percentile of those families rose in lockstep with the median income. But if you fast forward to 2024, that ladder might as well be the Eiffel Tower. The Gini has ballooned to 0.46. So real family income for those families in that 20th percentile has not budged since the Ford Pinto. Meanwhile, the 95th percentile is up 60%, which means the elevator for the top floors of the income earners kept humming, but the stairs for everyone else collapsed into a treadmill. So when you ask, how did we get to be a nation where teachers need side hustles and hedge fund managers need new zip codes for their garages? Well, the answer is fiat dilution. When money is conjured out of thin air, it does not rain evenly like manna. It flows through banking pipes straight into assets. Capital gains soar, executive compensation is stock option rocket fuel, and then the price of admission to the middle class drifts out of reach. Meanwhile, the wages are priced in an ever-expanding currency. They're losing purchasing power in slow motion, and the result is a barbell society. Asset-rich on one end, anxiety-rich on the other, with the former middle hollowed out like a donut. Over the last 50 years, whenever you've heard policymakers talk about things like inclusive prosperity while approving trillion-dollar stimulus on a keystroke, remember that you cannot fix structural inequality with more of the substance that caused it. You need a monetary foundation that cannot be diluted, captured, or lobbied. Something with a hard supply cap instead of a lobbyist speed dial. And that's why the path out of this widening canyon runs straight through sound money principles and, yes, through Bitcoin. Another interesting graph to showcase my points for you guys here: worker pay has not kept pace with productivity since the 1970s. The blue line is the hourly compensation, the orange line is the net productivity, and you can see right here in 1971, that is quite the divergence. This is a graph of that Gini ratio for families increasing, and look, it was actually going down before 1971, so income inequality was getting better when we had a society built on sound money. I want you guys to take a long nostalgic look at this humble can of tomato soup right above my head here, not the Andy Warhol version. And the reason why is because for 70 straight years through 2 world wars, the moon landing, the Beatles' entire discography, that red and white icon cost less than 20 cents. Then the 1970s hit, which means fiat money hit the accelerator and the price chart went vertical like a SpaceX rocket launch. So today you're lucky to snag it for $1.25, and that's before shrinkflation shaves an ounce off the can. And you might be asking, why does soup matter, Adam? It's just soup, who cares? But it's because it's the grocery aisle seismograph. When processed tomatoes cannot hold their price, you know the monetary Richter scale is spiking. The energy crisis and food shocks of the 70s baked permanent inflation expectations into the economy. Paul Volcker's 20% interest rate napalm knocked down the flames for just a little bit, but the embers never fully died. And remember, official CPI claims that everything's fine thanks to hedonic adjustments and substitution tricks, which means sure, steak got spicy, just eat chicken. They'll replace steak in the price basket for chicken. Go to shadowstats.com. The nerds over there are running the numbers without the government's rose-colored smoothing, and they show double the headline inflation for essentials like housing, healthcare, and tuition. So in other words, the thermometer that they show on TV, that the politicians, that the president is always talking about, it's conveniently stuck on lukewarm while the kitchen actually feels like a sauna. So when the unit of account, which is the US dollar, is elastic, every price tag then becomes an escalator. And families have not noticed the ride day to day since 50 years ago. You can't hear inflation creeping, but you can check your grandparents' grocery receipts and you'll see this silent tax in action. This is why stacking dollars in a savings account has become a slow motion donation to whoever gets the new money first, and why a capped, non-debasable asset like Bitcoin isn't speculation, it's insulation from monetary destruction. You can just look at how long it took to save for a house. The blue represents the years of saving and average income required to buy the average house. In 1970, 2.4 years of saving. Now that's at a 7. Actually, this is 2020. Now it's probably an 8 or a 9. And this is the home value change versus the income change from 1965 to 2021. Bit of a difference here. So the federal debt in 1971 was a modest house cat. It was actually only $398 billion curled up in the corner of the national balance sheet. But if you fast forward to 2025, that cat has mutated into a $37 trillion Godzilla, growing only $1 trillion every 5 months. Not a big deal. So this bar on the chart doesn't just dwarf 1971, it flattens it into a pixel that you kind of need a microscope to see. I almost felt stupid putting this graph up here for you guys. The next bar is the consumer credit. So in 1971, Americans carried about $144 billion on charge cards and personal loans. Today, we're staring at $5 trillion. Yes, Visa commercials taught us it's everywhere you want to be. And Congress made sure the interest clock never stops ticking. Then we have student loans, basically non-existent in 1971, but we all know how that went. Now it's a $1.6 trillion anchor chained to the ankle of every would-be homeowner under 35. We convinced an entire generation to leverage their future earnings before they had their first ever salaried job. What a brilliant idea. And then we jacked up the tuition faster than core CPI could blush. By the way, it's so obvious that government intervention in education made the price of tuition go up. If you guarantee financial assistance to people who would normally never go to college, why do you think the colleges wouldn't jack up the price of tuition when they know they're going to get the money? So anyway, sorry for that side rant. You might be asking why this exponential curve, but it's because once the money lost its anchor in 1971, debt became the business model. Washington literally just discovered that they could fund whatever war they wanted to. They could do tax cuts, stimulus checks without ever raising taxes, just auction more treasuries to the Fed's balance sheet black hole. And then what happened was that US households just mimicked the playbook. The wages lag, you swipe the card. Corporations followed suit, you issue bonds, then you buy back stock, and then you juice your earnings per share and repeat. So when the cost of capital is near zero in nominal terms and negative in real terms after inflation, that means that leverage is not a risk, it's a requirement to keep up. So this is what permissionless credit looks like: a nation on perpetual margin, rolling old liabilities into new ones while praying GDP outruns the interest meter. History is crystal clear, kids. No society compounds debt faster than production forever. Sooner or later, the bill arrives. The only variable is who holds the hot potato when confidence cracks. Just a heads up, a monetary system capped at 21 million coins doesn't allow this spiraling binge. It forces governments to live within taxation, businesses to fund growth from profits, and consumers to relearn the lost art of saving. Hard money is rehab for a debt-addicted civilization. Unpleasant withdrawal, sure, but the alternative is economic liver failure. So now we're getting a little bit past 1971, step back 2 years after the gold exit, and we watched Washington draft a different kind of gold standard, black gold. In 1973 to 1974, the US striked a quiet pact with Saudi Arabia. Price every oil barrel in dollars, park your surplus revenue in US treasuries, and we'll keep the royal palace safer than Fort Knox. So overnight, oil, the lifeblood of global industry, becomes a compulsory dollar subscription. If you want energy, you first need green paper or its digital entries, no exceptions, and the result was perpetual demand for the US dollar. So the countries running trade surpluses funnels their profits back into US debt just to keep the crude oil flowing. That artificial bid on the US dollar let America run deficits that would bankrupt another nation. No balance of payments crisis, no collapsing currency, just ever-growing IOUs cheerfully absorbed by the same petrostates that sold us the fuel. So with the dollar weaponized, Washington discovers a second dividend: budgetary elasticity for power projection, which means defense spending, military spending. It surged. Defense outlays rocketed to 6% of the GDP in the 1980s. They did dip toward around 3% during the Cold War victory parade, but then they rebounded to roughly 4% post 9/11. So when your currency is the oil umbilical of the planet, you can finance carrier groups and desert wars with treasury auctions. So the rest of the world buys the bonds, then they buy the bombs. So this feedback loop, the oil priced in dollars, then the deficits funded by the petrodollar recycling, then military muscle securing the oil routes, it turned the fiat experiment into this giant geopolitical flywheel. But it also divorced spending from democratic cost-benefit checks. The electorate never feels the full tax sting, so endless intervention becomes a line item rather than a national debate. Bitcoin would force the foreign policy to pass the same arithmetic test as everything else. In a hard money world, guns, butter, and global policing can't all fit on the same credit card. So let's take another trip back in time, not the 60s this time, but the 50s. I'm talking Johnny Cash. Let's go. So you're in your grandmother's living room, okay? The passbook savings on the mantle, Christmas club deposits at the local bank, and a pink ceramic piggy whose belly was actually filled with nickels and not credit card points. Back then, high savings rates were not a virtue signal, they were common sense because a dollar today would still be a dollar in a year. Deferred gratification came baked into layaway plans and community events, think Rotary clubs, church picnics. They were Friday night entertainment. The trust in institutions, yes, this data, it sat north of 80%. You could leave your front door unlocked and your pension in bonds. But now you fast forward to the post-1971 fiat psyche. The piggy bank has been swapped for a platinum Visa with a 20% rate. Advertising preaches FOMO and YOLO, buy now, pay interest later, because tomorrow's money is worth less anyway. Which means social cohesion in our culture has fractured as everyone competes on an inflating treadmill. You fight for scarce starter homes, bid up stocks to keep pace with CPI plus, and doomscroll political feeds that mine your anxiety for engagement. So the point I'm trying to make, and it's the point that nobody really talks about, I'm trying to bring it to the forefront more, is that inflation is not just an economic metric, it rewires a society's time preference. When savers are punished, households pivot to asset chasing and instant gratification. The civic fabric thins as people prioritize personal hedges over collective projects. Every percentage point shaved off of purchasing power is a silent tax on patience, trust, and long-game behaviors that build strong communities and social cohesion. Bitcoin would flip the script because it rewards future-oriented thinking by making tomorrow's purchasing power at least as strong as today's. So if we restore that incentive as a society, we can resurrect the cultural grammar of thrift, cooperation, and genuine investment in our shared collective future. So until then, expect more BNPL pop-ups, more polarization, and a credit card culture sprinting toward the next dopamine discount while the social glue quietly dissolves. Anybody that's been scrolling TikTok anytime over the past couple years, how every 3 TikToks is just an ad to buy some other plastic crap from China, you should totally get this. The Federal Reserve is literally just the ultimate helicopter parent. Every time the markets scrape a knee, it rushes in with a lollipop made of cheap credit. It started with the Greenspan put, cut rates, pump liquidity, and celebrate a rising NASDAQ. So when that bubble burst, the response was more of the same, culminating in the 2008 quantitative easing that turned bond yields into punchlines and taught Wall Street that risk is a temporary inconvenience, not a cost. And then cheap money just begets zombie firms, which is companies that cannot cover interest out of their profits, yet they shuffle forward by rolling over debt at near zero coupons. So instead of innovating, these companies, they issue bonds to buy back shares, then they goose their earnings per share, and then they hand their executives option packages that vest faster than a TikTok trend, which means the talent and capital drain into financial engineering because that's where the subsidy is the deepest. Meanwhile, the real wealth transfer happens quietly in retirement accounts and savings deposits. Grandma earns her 0.2% on her CDs while CPI clips along multiples higher. Savers bleed their purchasing power, but asset owners, the stocks, the real estate people, the fine art NFTs, for heaven's sake, they are the ones that capture the entire Fed put. So, in essence, the central bank socializes downside and privatizes upside, baking the cronyism into the marrow of capitalism. So this cycle is literally just self-reinforcing. The easy money inflates the assets. The inflated assets are then deemed systemically important. Don't let the banks fail. So when gravity finally asserts itself, the policy answer is always easier money. I want to bring back actual bankruptcy and consequences for your actions. We need to reward productive risk over speculative leverage. So until that discipline returns, you need to expect bigger bubbles, fatter zombies, and an even wider chasm between those who work for dollars and those who let dollars work for them. So I don't know how long this is. I don't know if I've been spending 20 or so minutes touring the wreckage of wages frozen, debt metastasizing, soup cans moon rocketing, zombies stumbling across Wall Street. But The obvious question is, now what? I'm going to answer this through 4 dimensions. Number 1, we need monetary integrity. The symptom is unlimited credit issuance. If the currency is an inflatable pool toy, politicians will keep adding air until it bursts. The remedy is to re-anchor money to something that refuses to be printed, gold if you like heavy metal, but Bitcoin for the cool people, the smart people, the ones who prefer 21 million lines of incorruptible code. And the second dimension is economic fairness. The wage productivity gap is the crime scene of the century. Hard money discipline forces the capital to earn returns through innovation and not balance sheet alchemy. So when credit has a real cost, executives will chase efficiency instead of their own financial optics. Then labor will finally get a seat at the table that isn't the kiddie chair. And the third dimension I want to talk about is the social cohesion. Think of the political polarization, the distrust flourishing in our society when everyone is sensing that they're sprinting on a treadmill that secretly speeds up every year. If we restore the incentive to save an honest yield on deferred consumption, people will start planning decades ahead instead of doom scrolling for the next dopamine discount code. Long-term thinking is social superglue. The fourth dimension is intergenerational justice. We've promised trillions in pensions and healthcare with no funding source beyond future tax receipts and fresh bond issues. A hard money constraint would slam the door on the fantasy that deficits never matter. It forces today's voters to pay for today's benefits, not dump the tab on the grandchildren who haven't even picked a major yet. If you guys want an amazing visual archive of the entire rupture of society, go straight to WTFHappened in1971.com and scroll until your scrolling finger cramps. The charts make one point in neon. America did not fall on a battlefield. It slipped quietly into paper abstraction on a Sunday night in August 1971. The exit ramp exists, but it's narrow and paved with hard assets, voluntary discipline, and a monetary network that treats dilution like a software bug, not a policy tool. So right now, what can you do? You can choose your lane. You can keep surfing on the fiat feedback loop or build on a foundation that respects scarcity and time. The stakes are nothing less than our prosperity, our social fabric, and the inheritance that we will leave to future generations, who will then turn judge whether we fix the leak or just kick the can one more block down the inflationary road. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video and subscribe to the channel. It really means a lot. I like to spread the orange gospel to the masses, and I can do it with your help. Have a terrific day, kids. Class dismissed.